Hey, welcome back, everybody. It's time once again for another episode of Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California, as we take our famously no BS look at both sides of the issue, driving the market today to find the best solutions going forward. And today, well, we've got the best group we've ever assembled here. Barry, bring us in. Who you got with you?
Yeah, good morning, Paul. Thanks. We're back here again on Let's Talk Real Estate for another week of delving into some of the unique aspects of the commercial real estate market, and I'm excited for today's show. I'm Barry Saywitz, president of the Saywitz Company and managing partner of Saywitz Properties, and if there's nothing else that I've learned in the 30-plus years that I've had in commercial real estate, it's the most important thing is to look at both sides of the equation and try and come up with the best solutions for solving all the real estate problems, and that's what we're going to talk about here today. So I'm excited for a couple of reasons. Number one, we're taking an attempt at having two guests instead of one, so that's unique for us. And number two, I'm excited because I've got two guys I've known for a long, long time who work for the Saywitz Company, Andrew Herron and Robert Ritshel, Senior Vice Presidents with the brokerage division of the Saywitz Company. Guys, welcome to the show.
Thanks, Barry.
Thanks, Barry.
Yeah, so before we get started, I want to do a shout out for today's show to the Los Angeles Rams. I'm excited to have them play in their home stadium, and super excited for them to have beaten their rivals, the 49ers. Also, a shout out to all those out there that are celebrating the Lunar New Year. Enjoy the festivities. Happy New Year. Year of the Tiger. Let's hope it's a good one for everyone.
Let's go Bengals.
Yes, right.
Yeah,
With that said, let's talk real estate. Guys, welcome to the show. I want to talk today about lease negotiations, the current state of the real estate market in both the office and the industrial side of things from a tenant's perspective. And I know that's what you guys specialize in, and I know from personal experience that's what the company is focused on. So let's start, Robert, with you. I know that both of you guys have been in the business for 25 plus years, well seasoned in experiencing ups and downs in the market, landlord's market, tenant's market. Today, no question that it is a landlord's market on the industrial side of things. Couldn't be tighter. What's your perspective of what's going on today?
No, that's exactly right. I think we haven't seen rental rates. We're all-time historic highs for particularly industrial, for sure. We've seen rent growth, steady rent growth from 7 to 9 and 10% year over year in the last 5-6 years. So for somebody that was locked into a 5-year lease or even a little longer lease, and they're just coming out of it this year, last year, are facing a substantial increase and sticker shock, frankly, particularly if they haven't been tracking the market closely and they haven't had people reach out to them and explain to them what's going on in the market.
So, I mean, I think, I don't want to put words in your mouth, but to sum it up, it's a challenge if you're a tenant in today's market, true?
It's a challenge, and it's a challenge for brokers to get their head wrapped around this new number because they don't get it. They look at other things that are happening in the economy, or they look at their own business. They say, hey, my business isn't growing 10, 15, 20%. Why is my rent getting jacked?
Sure. And Andrew, from your perspective, what are you seeing out there in the marketplace when you're meeting with and talking to owners and CEOs and CFOs of companies, and they're now faced with a lease that's coming up and they have yesterday's number, and now you have to explain to them, hey, here's where the market is, and you're the bearer of bad news?
Well, you're exactly right. It's an education process. So you just need to talk to them about, exactly what's happened and transpired over the last, 7 years of this historic rent growth. Showing them, the facts. They typically just don't believe you until they see what the vacancy rates are. And when you've got a 1% to 2% vacancy rates in these industrial markets throughout Southern California, it's a better story to tell, because then they understand it's just a supply and demand curve.
And is there much of a difference in the vacancy between Orange County, LA County, Inland Empire at this point? Certainly there were issues when COVID hit and the market had a blip. But the fact of the matter is, if you look at today's environment, COVID aside, I think you can just put it on the back burner relative to talking about the industrial market, because there is limited vacancy. There is still high demand. Is there a difference from the coast to the Inland Empire at this point?
5 years ago there was, you had maybe a 4 to 5% vacancy rate out in the Inland Empire. But since the port has been inundated with, these cargo ships and having to get the product off the port in a timely manner. Now the Inland Empire is, the hottest market, and the market that's frankly just increasing the most year over year. Vacancy rates are all hovering in all of these Southern California markets, between 1% and 2%, depending on, where you are.
So Robert, if vacancy is 1% to 2%, what happens then? You have a client, right? So for those viewers and listeners out there, I'm going to give a little plug. So the Saywitz company just represents tenants and users of commercial real estate. It doesn't represent any landlords or developers. And so when these guys and the other folks at the company are meeting with clients and potential clients, it's really to help the tenant or the company or the user come up with a solution. So my question, Robert, is, so you're meeting with these companies and there's 1% to 2% vacancy. What does that do when you get out in the market and start to go look at options? Is there limited options? Are there multiple people looking at properties? How does it go?
Yeah, that's a good point, especially if the building works well for that tenant, and if they have a specialized use. You're not going to duplicate it easily, finding another building and recreating the wheel, because that means you're going to have to refit the building, the cost of moving. It doesn't make sense. Even to save a nickel or two, if you find something that's a little cheaper, it never pays you back in terms of downtime you have and loss of production. So we try to create a scenario where we're creating a competitive situation for that tenant's business, but we're also looking for other opportunities in the market that could still be a good fit. And then we find ourselves taking that tact. Sometimes we have to go outside the area. We just leave the area entirely. We're hearing from our clients that they don't necessarily need to be in Orange County. We have a couple clients that are looking in Texas or outside the area. But for those companies that are not looking, there's still an ability to find enough opportunities to create some competition for their tenancy. But if staying is the best option for them, then that's why we try to start the process early.
And so, Andrew, when so I'm going to just play devil's advocate. I'm a guy, I'm a business owner. I want to look at all my options, and I want to see, if staying's really the best one financially, as well as if there's a better, nicer, newer, more efficient building out there. How do you guys go about doing that? And why would I use you guys to help me as opposed to just doing it myself or going on the internet trying to find something that's out there?
Staying's always going to be your cheapest option, depending on who your landlord is. Because if that tenant leaves, as that landlord's going to have downtime. They're going to have marketing costs. They're going to have tenant improvements. There's a multitude of reasons why an existing credit tenant should be getting a better deal off the street. But the landlord's just not going to do that unless they think there's the possibility of that tenant leaving. And so that's the leverage that we create on the tenant's behalf. We show the landlord that, hey, look, you're not the only game in town. There are other options. No matter how tight the market is, there are other options out there. So the education process and starting the process early is the key. The more time we have, the more leverage we can create.
And isn't it a education process both for landlord and tenant? I mean, as a landlord myself, I believe, if I put my landlord hat on for a second, I believe the market's super hot. I believe I'm bulletproof and I can make up any kind of number and I'll get it. And from a tenant's perspective, I got sticker shock and I don't know how I'm going to be able to afford it, and I can't even raise my prices enough to cover what you're going to stick me with if you really jack my rent up.
Right. No, absolutely. The landlord is typically more educated than the tenant, going into the renewal process. The landlord understands what's happened to the market. So the worst thing you can do is request the number from the landlord. The best thing you can do is be proactive and present the landlord with your number to start the negotiation process. It just benefits the tenant 9 out of 10 times.
And so, Robert, how do you come up with the number? I mean, what's the number? Obviously, for me, if I put my tenant hat on for a second, less is better than more. I'd like to keep my rent the same. How about just give me a 3 or 4% increase for cost of living and then just roll it over, and landlord says, no way. Right? How does that go?
No, I understand. And in the past, we had concessions to draw new tenants into a building, a vacant building, which are off the table. I mean, we're finding that it's difficult now to get rent abatement, free rent. You might get some beneficial occupancy at some time for you to make the switch to help you get into the new space. But trying to explain that to your client, where in the past they're used to getting up to a month of free rent for every year that they signed a lease, it's gotten more difficult. But I think on the other side of the coin is the leverage we have typically is with a tenant that pays the rent on time, that has a good history of paying the rent and not being difficult with the landlord. Is a boon for the landlord to keep that tenant, because the other issue is credit.
Well, and there's the unknown, right? If I get another tenant in there as the landlord, I don't know if he's going to pay the rent or make it or beat up my building or whatever. At least with the existing guy, I know what I got.
Yeah, because if you're not moving because the rents are escalating and it makes no sense to move, cut a new deal, who's left in the marketplace looking for space? And it's typically the guy that couldn't pay the rent in his last place, and now he's in the market again looking. And that's why credit's a bigger issue than ever. Even though landlords are rejoicing they're getting more rent and a higher price per foot, it doesn't necessarily mean that everything is golden when you're out the market looking for the highest rate, unless you're in a different category where we're looking at much larger space. We're dealing with large Fortune 500 or 1,000 companies, but with the smaller regional firms, that's not the case. Usually credit is very important.
And so, Andrew, at the end of the day, I mean, am I just taking what the landlord gives me and then I sign on the dotted line and hope it's a good number? How are you guys able to, I guess, if, again, I just want to put my CEO hat on for a second, how are you going to get me a better deal than I could get myself? I negotiate every day for a living. Why do I use you? Why do I use any broker? Why don't I just call up the landlord, take him to lunch, and really try and be nice to him and buy him a box of chocolates and hope he doesn't, sting me with a bad rent?
Well, you lose all leverage when you try to negotiate directly with the landlord. You go to the landlord, you say, hey, Mr. Landlord, I want to renew my lease. Well, he knows a couple things. He knows, number one, that you're not looking at other options in the marketplace. Why? Because if you were, you would have sent your broker. Number two, he knows you're probably not educated on the marketplace. Why? Again, because you probably would have sent your broker, or at least met with your broker at that time. Always have somebody represent you. It just creates leverage that you can't create on your own. And just by bringing, a tenant rep in that specializes in kind of what we do, it instantly creates leverage and adds value.
Plus, it seems to me, I mean, I know the answer, but it seems to me you're better off hiring an expert. And if you're a smart business owner, you're a smart CEO, you want to surround yourself with experts that will help guide you through whatever aspect of your business it is. That's why people hire attorneys. That's why people hire accountants. That's why people hire PR firms. And that's why you hire commercial real estate brokers to help you.
Absolutely.
Because aren't you making a deal that's going to financially impact your company for years to come?
And we're not talking about little amounts of money. We're talking about large amounts of money on large square footages.
And depending upon the size of the building and the rent, it's certainly hundreds of thousands of dollars, if not millions of dollars, right to the bottom line.
Yes.
So, Robert, back to you. Let's talk about the need or the desire for the tenant when they go to look at these other options. What about buying a building? So, again, I'm going to put my hat on and go, hey, if my landlord's going to jack up my rent, if there's other buildings out there that are really expensive, why do I want to pay the landlord rent? Why shouldn't I just own the building, control my own destiny? The market's hot. Maybe it goes up even more, and maybe I should own a building. Are you seeing that?
That's a great point. We bring it up every time we have an initial contact or meeting with a new client or prospect. And right now, with SBA financing being so attractive, and it's probably definitely has put pressure on the cost per foot on properties that we've seen also an increase that's paralleled the rent increases. But if we break it out and we explain to them, look, if you're able to insert 10% into a deal into a purchase with an SBA, let's say a 504, if they're not familiar with SBA financing, we're able to get them financed as fairly competitive with renting. I think I just talked to one of our brokers yesterday who arranges SBA financing, and it's something like $5,300 to service the debt on $1 million you borrow. And if you know that you need certain amount of square foot for your business, and we know what the purchase price will be, and if you work out that number and you add expenses, it's fairly close to leasing. And now it opens up some possibilities for your client to really think about now acquiring real estate apart from running their business. Now the big question is, do they have the capital to free up to put into the down payment, because a lot of them are using that to grow their business. So it depends upon where they are in their business cycle. Newer company, not so much, but an older established company, Absolutely. And Andrew and I have been very active in sales, industrial building sales, particularly in the last couple of years with these types of scenarios where you had mature companies are ready to make the push, and some of them were in a manufacturing situation. They said, hey, I don't want to move again. Cost me $1 million to move my stuff. I should be buying something.
Yeah, so it seems like if I've got heavy capital outlay, if I'm not going to be moving very often, and I don't expect huge growth in terms of my size where I could outgrow the building, buying's actually a pretty good option,
yeah,
right?
absolutely.
The issue is, Andrew, I mean, what if I expect big growth? I mean, should I be buying? And what's the answer to that one?
I think if you've got the ability to buy now for sure. You can always, keep it and lease it out at the end of the day. If you outgrow it, that's a good problem, right?
I guess, or I get a second building or buy another
Sure.
building down the road, right?
Sure, but with everybody having access to cheap money right now, I mean, it's the SBA rates are as low as they've ever been historically, right?
Right, and isn't that one of the really key factors in making the fact that the prices are so high
Yes.
a little more palatable to swallow? Because it doesn't really matter. I mean, well, it matters. To me, it doesn't really matter what I pay for the property. It's what my monthly expense is. And then aren't I just going to compare the monthly expense of owning against the monthly expense of paying the landlord? And in the scenario where I own the building, it's mine. And in the scenario where I'm paying the landlord, I don't own anything.
Right. And you've got the depreciation and tax benefits, etc.
Of course. And you control your own destiny. And if it happens to go up, I made money on paper or
Right.
eventually for real. So the industrial market, tight as a drum. I mean, we've had other guests on the show, and everybody says industrial has been the darling sector of the commercial real estate market, and will continue to be. Do you see any changes going forward? And what about the tightness of the market? Is there multiple offers, multiple bidding, and how do you deal with that? Robert, I guess start with you.
Yeah, so we do. We have a lot of assignments where we're putting together a matrix of all available space, and a lot of the rates are withheld, and it's on purpose because today every broker, every landlord is looking at what the last deal was done on their street or in their market and what they're paying, and that's the new rate. And so putting these numbers together and getting your client in front of the opportunity is key, because we find that once we find the right opportunity, there's already 5 guys looking at it, and they probably have 3 or 4 offers. Everybody's putting their hat in the ring, and so it is competitive, and especially if it's a newer Class A, 30-foot clear ESFR, what we term as a state-of-the-art building, and now they're up to 40-foot clear on the larger buildings with a large truck court, a lot of dock positions, everything, all the bells and whistles that everybody wants. Those are the ones that command the highest rates, and for obvious reasons. And then consequently, the expense portion is also going to be higher just because they're brand new buildings. But those are the ones that people want.
Yeah. And so, Andrew, doesn't that get back to your whole thing about starting early and being prepared and being educated about the market so that you can jump on something when it comes along?
You can, but no landlord's going to lock into a new deal with you until you're, plus or minus 6 months prior to lease expiration, just because what Robert just said. I mean, the rate continues to increase. The longer the landlord can hold you off on cutting a deal, the more benefit it's going to be for the landlord.
But can't I go back a year before my lease is up if I think that the market's going to continue to go up and make a deal with my landlord now? In some instances, it might take me that long to move.
Yeah, manufacturers really need to be ahead of the game here, because you just can't pick up your toys and move, right? So we've had a lot of success in approaching landlords, a year plus early on the manufacturing side, and sometimes on the distribution side as well, trying to lock into the rate sooner than later.
So what I'm hearing is, if I'm the landlord, I want to wait until the very end. Number one, I gain more leverage as it gets closer to the end of the lease because I know you're probably not going to move in the renewal.
Yep.
Number two, it's more likely that somebody else would come along and have a serious interest in the building if it's closer to the end of the lease when it could potentially be vacant. And number three, it's really advantageous to the tenant, especially in this market, go back early and try and get it sorted out as soon as possible.
Yeah, if you can cut a deal today, cut a deal today. There's no doubt about it.
So the other question that I've got is, interest rates. Let's just talk about that for a second. They are at historic lows. And there's rumors now that interest rates are going to go up. How do you see that impacting the pricing? Is it simply just a supply and demand, and there will continue to be high prices because there is high demand, and you'll just have to pay more if interest rates go up, your mortgage goes up? Is that, Robert, is that how you see it?
Potentially, but I don't. The impact isn't immediate. I mean, it happens when the Fed decides to raise interest rates. It happens, but in terms of impacting the market and rates, it's just like a slow moving train. It doesn't impact it directly overnight. People are still in the market looking. They realize that there's things that are forces beyond their control, including interest rates, and if they're ready to pull trigger and need to make a deal, they will. I mean, I think some people will look at that and go, and we get those procrastinators clearly, and we just met with one, and it was hard to hear what happened to them. We've been talking to them 8-9 months early, and they had that view like, you know what, if we just wait a little longer, things will change. I think the market will turn in our direction, and this happened to be for a lease extension, and they decided to do it themselves. I mean, they were going to give it a shot, and you know, time goes by, people get busy, and then they're not talking to their landlord, and the landlords keep sending them offers, and they go, well, that's high. We're not going to pay that number. It's going to be this number. They go, no, this is the number. And now we're about 3 months from the end of your lease, and now we're going to give you an expiration date. If you don't respond to this proposal and take this number, we're going to put it back on the market. And they let that time slip by, and it's exactly what the landlord did. They contacted their broker. He just would simply walk next door, asked the neighboring tenant if they wanted their space. They said, sure, right now. They signed a lease within a week.
And so they're out.
They're out.
So I mean, I don't want to use the word dumb, but dumb not to start early, right?
And Barry,
I mean,
we're hearing this often. Unfortunately, we get to them when it's too late because we just trying to start a new relationship, and then we hear the story. But I think to Andrew's point, I mean, we have negotiated deals where we were a year out. It was difficult to do because now we're trying to pinpoint a number into the future, and that's the discussion. Everybody's fixated on, okay, so this is the rent that everybody's willing to pay today. We think that's a good number, but their lease isn't up for 9 or 10 months. This is how.
But isn't that how you're adding value, and isn't that how,
sure,
as the tenant, you're saving money? Because, Andrew, don't you have deals that you did 18 months ago, and you're like, you call the client and go, you're a hero. I'm a hero, right? I mean, I locked in, and let's just use real numbers. I locked in 18 months ago for an industrial building in Orange County for, doesn't matter what square footage. Let's just say you locked it in at 80 cents, and today the market's $1.10. The difference between those two numbers alone is 30%, right? 40%. It's huge. It's right to the bottom line.
Oh yeah, if you can save them that 10, it's going to be 10% higher tomorrow. I mean, it just is.
Yeah. I mean, and are you seeing? I know you are, but I want you to tell the viewers and the listeners out there: are you seeing landlords retrade the deal and make up new numbers in the middle of the conversation because the market is moving so quickly, and they find out about some other deal that got leased or sold at a very expensive number, and then they just make up a new number?
Yeah, if you drag your feet, the number changes overnight.
Yeah,
no doubt.
And so it's certainly a challenge. I mean, I what I'm hearing from you guys is if you're a tenant out there and you're listening, start early, get professional help, get educated on the market, and then get your ducks in a row so you can react quickly and early and decisively, and you will make a much better deal. True, not true?
Absolutely true.
Yep.
So let's shift gears for a second. I want to talk about the office market because flip side of the industrial, and I don't want to say it's in the tank because it's not, but there's no question that the office market has struggled much more than the industrial. While the industrial market has continued to flourish because you have more product coming from overseas, you have more demand for supplies, and then you have more logistics companies that are taking these bigger warehouses like Amazon and Walmart, et cetera. The office market, different story. You have a lot of people still working from home. You have employers looking at reconfiguring the workspace so that they don't have workers on top of each other and trying to get newer, more efficient, better, more laid out space. Now, on the one hand, you might think, and I've thought about this from our own business perspective, if you're trying to spread people out, you might think you need more space because you don't want people on top of each other. At the same time, every owner of business that I've spoken to has said, no, I'm trying to get less space because I'm trying to save money, and we're trying to figure out how to make it work. I mean, Andrew, what are you seeing out there in the office side of things from the folks you're talking to?
It's exactly that. You know, the business plans change. This work from home thing works for a lot of companies. I met with a client yesterday, you know, that had 3,500 feet here in the airport office market. And I walk in the office and there are 2 people in there, you know, and he says, Andrew, exactly right. How do I reduce my overhead? I said, reduce your footprint. I mean, it's that simple. Does the work from home thing work for you? And he said, yeah, I've got my employees working in 9 different states across the country. I just don't need them coming in anymore.
And I think, Robert, I mean, I'm curious your take, but I mean, I think it varies from industry to industry and company to company. There's certain companies that cannot function without their people coming in the office. They need the synergy, and there's others that it's perfectly fine for them to work from home.
That's absolutely true. And I'm thinking about our own business. I love coming in the office, and I think there's that synergy and working together, and we got teams that need to see each other at least once a day or twice a day. It's not the same doing it over Zoom. And there's seems to be a movement afoot, and I've been reading it in the press, and particularly the real estate press, that companies and decision makers for Fortune 500 companies are now saying, hey, it's not working for us. And I think you're right. It depends upon what you do, how your employees work together, the type of business that you have. So there are companies that are coming back to the office. I had a couple clients that are doing that, and they're for those various reasons that I just described on how our business works and the kind of synergy we have with our own employees. But with a company where most of the work is done independently, and they get a pile of work and they can do it from home, and then they can any meetings they need to have, they can have over Zoom.
So what does that mean when my lease is up and I'm putting my tenant hat on for a second again? I'm going to pretend to be the owner of the business. My lease is coming up. I have office space now, right? So the market's a little softer than the industrial side of things. I'm trying to look at more efficient or different or less space or give back some space so I can save some money. How does that play into the lease negotiation? Just like we were talking with the industrial, do you have to go back and start early again?
It's timing, right? If you just signed a lease, and Andrew and I had a meeting with another client, and they just signed a lease. They basically want to make sure they didn't get a bad deal, and then their employees were slowly coming back, and they were kicking around the idea of subleasing about half of it, or maybe even the whole thing, and just moving out and find another space. But to your point, if you're within a couple years or maybe a year, you still probably have to look at subleasing versus just trying to cut a new deal with the landlord. It's just not going to take the space back.
So, Andrew, is the landlord going to let you out of your lease if you cry COVID and say, my people are working from home, I don't need the space? How's it go?
Well, they definitely don't want you to leave. They're going to lose rental income, but they'll definitely be open to, renegotiating something with you sooner than later. So take example, this meeting I had yesterday. The guy's got, 9 months left on his lease, and he's paying about a market rental rate. I could go back and, negotiate that rate down, extend the term today, and save him money today. It's if you look at your lease and your landlords are hungry and they're scared. They just don't want to. Vacancy rate in the airport area for Class A office is about 18%. Overall market in Orange County is probably hovering around 12%.
So big difference between the office and the industrial. I mean, if industrial is 1 or 2, and office is in the teens, big difference, supply and demand, right? And then the other thing that I find interesting about the office market is when a tenant moves, the cost to retrofit the space is significant. The code upgrades, the lighting, the ADA requirements, the carpet, the paint, the moving the walls around. You don't have any of that, or very little of it, I should say, on the industrial side, because it's just a big box. On the office side, I got to reconfigure the whole thing. It's very expensive.
Yes.
So back to this negotiating leverage in terms of your guys' role, adding value, creating leverage with the landlord. On the office side, how does it differ, and how do you create the leverage if I'm the CEO guy going, how can you help me?
Well, on the office side, you've got a million different options you can show your tenant. And the landlord knows that if they're unable to cut a deal with me today, that the possibility of me taking that tenant out to the marketplace is almost guaranteed.
And so can I go back early, negotiate a deal, get some improvements, get some goodies or some concessions, and sign a new lease?
Absolutely. And if you want to look at the market, I can tell you that, we can talk about a large free rent package. We can talk about a large tenant improvement package. And for the right credit tenant, the relocation allowances are out there. You just got to ask the right questions.
So what I'm hearing, Robert, is office, much easier, much more different dynamic in terms of availability than the industrial side.
Absolutely. At least your worries is not finding the right space. If you're an office user, there's plenty of space out there. It's a question of what you need. I mean, people don't, people are still trying to figure that piece out with some employees working from home.
So we just got a couple minutes left. I do want to touch on, so if I'm that CEO and I'm asking the question, how do you guys get paid? I mean, how does it work?
Have you ever bought a house?
Yeah.
A couple, one or two.
Yeah.
Yeah. So, I mean, it's just like buying a house. You know, you have your own representation. Landlord has a listing on the building. The listing agreement pays the tenant's broker. I mean, there's no out-of-pocket cost to use a tenant rep. And for anybody out there that's skeptical about it, don't be. It is the value that we bring to the table far outweighs any savings you think you can create on your own. We do this every day for a living, and we save our clients hundreds of thousands of dollars.
So short answer, landlord pays the fee, or in the seller case, the seller pays the fee. And while there's no free lunch, you would be foolish not to hire professional help because there's no out-of-pocket expense. Robert?
Correct.
That's it.
Absolutely.
In a nutshell. So, final thoughts, Robert. Where do you see the market going in office and industrial? Is it going to stay the same? Is it bouncing back? Is it going to take a dump in 2022, or are we just going to see more of the same?
Well, if we look at some of the metrics and the analytics from some of the people predicting the future on the industrial side, it's not going to accelerate it at the same increases we've been seeing, but it'll taper off, but the demand is still there. There's no question about it. And it's a question of new product coming online, and will tell us in the next 18 months, how that's impacting the demand. In terms of the office, it'll eventually come back, but I mean, it's a good time to cut a deal. I mean, landlords know it's a very competitive market. There are a lot of owners looking at the same problem. Tenants, they're downsizing, and there's a lot of space coming back to them.
And Andrew, final question for you. Do you see things like inflation, like the stock market volatility, like government involvement having a significant impact on the real estate market, at least for 2022? Nobody's got a crystal ball. Or are we still back to the same age-old supply and demand? Will things dictate the market, or are you just going to be back to, if there's three guys looking at building, the price is going to get run up?
Well, I think it always is supply and demand, but with inflation creeping up, you're seeing landlords pushing larger increases based upon, consumer price index. So it's always going to be a supply and demand curve, and when there's no supply and there's large demand, rental rates are going to continue to increase. It's just simple, and they're going to continue to increase by more than 3% like they have in the past. It's going to be 4, 5, 6%.
And for the business owner out there that's listening, that's got a lease coming up, that's thinking about buying a building, sooner versus later?
Yeah, look at all your options now.
Got
Absolutely.
it. So for those of you out there, sooner versus later, get some professional help. These guys are available. I'm pretty sure of it. I want to say, I think that's all we have for today, but I want to say it's always a pleasure to chat with you guys. We do it all the time. We could go all day back and forth with examples and different nuances. We'll probably do it again at some point in the future, and we'll check your predictions as the year goes on. So I appreciate your thoughts, and certainly for selfish reasons and for generous reasons, wish you extreme success in the coming year.
Thanks.
I'm Barry Saywitz, president of the Saywitz Company and managing partner of Saywitz Properties. I want to thank you guys for being on the show. I want to thank our viewers and our listeners out there. And I want to thank Paul Roberts and the whole team here at OC Talk Radio, our producer, Sophia, and to everybody that involved in putting the show on. We will be back next week. I am Barry Saywitz. We will talk more real estate, and we will see you then.